All right, in this lesson, we're going to be taking a look at the notes receivable side of the house. Up until this point, we've been looking at things that are related to more on the accounts receivable or the trade receivable, but we really haven't talked about notes receivable. So from this point on until the last lesson, we're going to be talking about notes receivable. So in this lesson, we're going to refresh your memory on what notes receivable are and some of the nuances and differences that notes receivable has from accounts receivable. So let's get started here. A note receivable is really like an accounts receivable. However, a notes receivable is what we like to call a formal method of providing credit. And really what makes it formal is a formal document with terms and structure, more structure of payment than the accounts receivable. Now, why are notes established? Well, there's really three reasons why notes are established in a company. The first reason is that a monetary loan is made to another party, whether it's an employee or another business. So sometimes when you get a new job, what might happen is because there might be this latency between when you get your first paycheck and when you start, a company may offer you the ability to borrow against your first paycheck. So let's say you get paid $5,000 on your first paycheck. On that first day of work, they might say, hey, you can borrow up to $1,000 against your first paycheck with maybe an interest rate, maybe not, as a way to just get you started in this new job, especially if you've moved far away. So that is one way that these notes receivables get established. Being an employee or just another business, you're loaning them money or you're providing them a service or credit, but you want a more formal document that says that they've bought it on credit and you want some structure to it more than the accounts receivable. The second way that notes are established, company sells a product to a customer. So in this case, we're actually selling something to a customer, and instead of having the customer pay us, use an accounts receivable, we use a notes receivable, meaning that we want them to sign a document saying that they owe us this money and all of the terms associated with it. A lot of times we just use accounts receivable, but sometimes we need to use a notes receivable. When do we use it? Sometimes we use it for those companies that we're just not sure they're going to pay us back right. And so we want a formal document, which makes it easier for us to sue because we actually have their signature on paper saying that they agreed to repay us back. The third way that we can establish notes is take an accounts receivable and convert it into a notes receivable. So this one's kind of like the last one. The only difference between this one and the last one's like a direct thing. Customer comes in, they buy something, and we provide them a note, and then before we give it to them, they sign the note. So that's like kind of on day one. The second one, the last one here, the accounts receivable is converted into a notes receivable, typically happens when a customer has defaulted on their accounts receivable, they haven't paid us, and then we get a hold of them and they're willing to pay us, but they need a little bit extra time. So we sit down and we say, okay, we're going to convert it from an accounts receivable to a note. We're going to draw up this paperwork that says that you're going to repay us $100 a month for 3 years with a 2% interest rate or whatever it might be. So we're actually making it more concrete as far as the loan terms than just a informal accounts receivable. So this type happens with those customers that haven't paid us on time and have been having issues paying us. We convert it to a notes receivable. That way, again, if we want to take them to court, we have a little bit more of a legitimate document that we can present in the courtroom. So that's another reason that we would establish a notes receivable. Now, some characteristics of notes receivable. So notes receivable are different than accounts receivable for some of these following reasons. The first one is that an agreement is usually signed between the parties each time a note is taken out. So without getting too deep in the weeds, when an accounts receivable happens, usually I'm delivering product to a vendor or a customer, and then the customer is accepting that delivery, and then they might sign a delivery note. That delivery note just says that they received it. That's not that they owe us any money. So that isn't a formal note in that respect. That's just, hey, we're going to receive it from you guys. Now, a note receivable typically is more formal where there's actually a loan document. It's like a loan document that they actually have to sign with terms and all the information they need about that debt that they now owe us. So it's a more formal agreement rather than just an informal credit that we would give them under an accounts payable situation or receivable situation for us. Second thing, interest is usually attached to the note. So with an accounts receivable, we typically don't incur interest, or we don't have interest attached to it. It's just you pay us in 30 days, you pay us the amount that you would owe us. On a note, on the difference between that and a note actually has an interest rate, and an interest is due at periodic points in the note. So interest on day one. Now, if an accounts payable doesn't pay on time, there may be interest attached to it after that, but there is this grace period of they have 30 days to pay and there's no interest attached to it. But if they don't make it within 30 days, then interest is attached to it. With a note, the interest starts on day one. There is no grace period. And then thirdly, a repayment term is definitely defined. Now, I know you might be saying, well, isn't net 30 a definitive time? Sure, it is a definitive time, but it's not as concrete. You could probably push it off a little bit and you'll be good. Or you bring it forward, especially if we have 210 net 20 or 210 net 30 terms. With a notes receivable, a repayment term is definitively defined in the note. So in the note, it says exactly when it's due and when the interest payments are due. And as we talk about these long-term notes, it gets a little bit more complex, but we have a defined calendar of when things are due. So those are some of the characteristics of a notes receivable. Now, understanding interest when it comes to notes receivable, in this section, our focus will be on the interest portion, because my assumption is that at this point in principles, you should kind of know what a notes payable is or a notes receivable. So we're going to focus more on the interest aspect and helping you understand how do we calculate interest and the intricacies of calculating those interest revenues for us, the company who's lending money to a customer or to an employee or to another business. So that's what our focus is going to be. So that was our review of the notes receivable. It's the amount that is owed to us. Typically, these are long-term items, not short-term, and it usually is a more formal way of creating a credit relationship between two parties. So that is a look at the notes receivable. We'll see you in the next lesson. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or click in the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.